So if you watched my recent video called Tax-Free FIRE, you might remember that I touched on the subject of choosing the right level of risk for your income withdrawal strategy. I then followed that up a couple of weeks ago with a video that talked about the risk of not taking enough risk, either while approaching or in retirement. But working as a financial planner, what are the biggest investment risk mistakes I've seen and continue to see people make over the years? And how can you avoid the same traps? That's what I'm hoping to answer for you in today's video. If we haven't met before, I'm Bourne. I'm a financial planner based here in the UK, and I help people achieve financial independence early, tax efficiently. I do that through advising on the correct use of tax allowances, wrappers and reliefs, but also by guiding people through the risk and investment maze. So, if that's your thing, why not subscribe to the channel? You never know, it might just help you on your path to financial independence. If you do find this useful, please drop me a little thumbs up below, I'd really appreciate it. And with all that said, let's get into today's video. Risk is a many-headed beast. It's just another word for uncertainty. And there are two important things to remember about risk right off the bat that will help you. It's not always a negative thing, and you can't completely avoid it. We all know there are different types of risk, but the biggest mistakes I see people make are 1. Being lulled into a false sense of security and failing to properly appraise the risk they're exposed to. 2. Reacting in the wrong way when a risk becomes a reality. And 3. Not taking enough risk in the first place. I'm seeing a lot of number 1 at the moment, with more and more people getting involved in investing because it's been made more accessible by apps like Free Trade and Trading 212. Not to mention that people have had all to do over the last 12 months. Those companies have made it cheap, they've made it easy, and they've brought stock market investing to the public consciousness. And that's not a bad thing, but it's also how bubbles are formed. When lots of people are buying, it pushes prices up. It's a simple case of supply and demand. When you've got more buyers than sellers, the price is going that way. It doesn't take much to spook markets though, when the prices are supported largely by people who don't fully understand what they own. They've just bought a price. And not knowing the fundamental value of something that you've purchased is at the heart of that first mistake. There's a famous story about Joe Kennedy, John F. Kennedy's father. I don't know how true it is, but apparently he decided to sell all of his stocks in the summer of 1929, just before the Wall Street crash, which preceded the Great Depression, because a shoeshine boy was giving him stock tips. And he thought, if the shoeshine boy's giving me stock tips, it's time to get out of the market. Now there's builders and barbers swapping crypto tips all over the country right now. Is it a bubble? Maybe so. It doesn't necessarily mean you should stop buying. You just need to be vigilant and not make the second mistake, which is reacting in panic when markets do crash, which they will at some point. There's often a herd mentality. The same thing that makes people buy when everybody else is, makes them want to sell when everybody else is too. It's one of those pesky biases that as humans, we base decisions on. What are people like me doing? Okay, I'm going to do that too. Remember though that your mind is a brilliant thing, but it can play tricks on you. We have to rely on biases to make snap decisions on things when we're processing such phenomenal amounts of information by the second. But they're not always accurate. If you were looking to choose a shorter, squarer coffee table for your lounge, for example, the one on the right is obviously the best choice. But you might be surprised when you realise that the dimensions are actually identical. It just proves that your instinct isn't always the thing to base your decisions on. You have to override instinct with thought. I've seen lots of people fall into this trap over the years. I get a lot of comments on my videos, for example, with people expressing concerns about UK stocks, primarily because the UK has underperformed in recent years. Well, if history is anything to go by, that's no reason to avoid a sector. It's quite the opposite. It's usually a strong buying signal. In my profession, we use the patchwork cloth of asset class returns a lot to demonstrate why basing your investment decisions on what has performed well is seldom a good idea. You only need to look at emerging market equities here. Had a brilliant year in 2007, at which point many people might have thought, right, time to buy in, only for it to be the worst performing sector by the end of next year, when most people had probably sold all of their holdings, subsequently missing out on 62% gains the following year to that. Now there could be good reasons for avoiding the UK on the surface, of course. The biggest listings do include so-called polluters and a lot of banks as well, which haven't been favoured. But the same people worrying about that are in the next breath expressing their concerns about inflation and rising interest rates, apparently not realising that rising interest rates are usually extremely beneficial to banking stocks. People who've only been investing for short periods of time aren't always able to connect those dots, and that's not a criticism, but there's sometimes a lot to be said for experience. So if you haven't got that, I really would just try and be as broadly, globally diversified as you can rather than being too sector specific. The biggest determinant of an investment's return is usually the investor themselves. So if you do invest, remember it's for the long term. Don't fall foul of mistake number 2 and panic sell just because values have fallen. But one way you're certain to get an inferior investment result is not taking any risk at all, or not taking enough. I had a really good comment from someone recently on an old video of mine asking at what point do market crashes become a bad thing for me rather than a good thing, in response to a comment I made about actually looking forward to market crashes myself. My response was that as a long-term investor, frankly, I never see a crash as anything other than a brilliant buying opportunity. If we look at long-term performance, there's certainly troughs, but never has the direction of travel been anything other than upwards. Market forces always ensure that there's a recovery, and usually quite quickly. In fact, there's only been 4 occasions in the last 100 years where the market has been down for 2 or more consecutive years. 4 years was the longest, which was the Great Depression. Then there were 2 instances of 3-year consecutive declines and 1 2-year decline. All other negative years were one-off events, and there's certainly been more up years than down. Quite often you find that the best and worst market days are quite close together, which underlines exactly what I mean about herd mentality. When markets crash, assets are usually oversold, and that's a combination of panic and automatic stop-loss facilities, which sell out of positions when prices reach a certain point, creating a sort of self-perpetuating downward spiral. What usually happens is that, quite quickly, the market realises that assets have been oversold. Prices have been dragged down much lower than they should have been, and the asset prices now actually represent fantastic value. This little chart from JP Morgan shows that really nicely. 6 of the 10 best market days over a 20-year period from the start of 1999 occurred within 2 weeks of the 10 worst days. And if you missed those 10 best days by panic selling when prices crashed, your annualised return would be almost 2/3 lower. Those are the biggest mistakes I see. So if you're fairly new to investing and financial planning, at least you'll know to avoid those. And if you're a bit more of a seasoned investor, it doesn't hurt to have a little reminder. But I'm going to follow this up soon with a bit more of a look at choosing the most appropriate risk profile for your goals, how risk scoring works, and how you may need to alter your risk strategy depending on how you plan to take income from your investments. So make sure you've subscribed to not miss that.